Well, good morning again, everyone. I'm David Ruffin, Principal of IntelliCredit, and we'd like to spend a little bit of your time today talking about the new credit cycle. And unfortunately, obviously, the COVID experience has ushered in that fairly dramatic form, this current crisis of potentially credit that we're involved in at this point. So again, some of you have heard previous webinars that we are very, very delighted to be part of the broader Quick Rate family. We began IntelliCredit in 2019 in many ways to complement some of the work that Quick Analytics does, and more a little bit about IntelliCredit in a moment. But the founding team of IntelliCredit has over 60 years of credit-related experience, either in financial institutions, through consultative work, loan review, over 350 due diligences, particularly in recapitalizations and M&A activity during the financial crisis, and so forth. So again, what we would like to do today is cover the effect of the COVID environment on credit, talk about some preliminary trends that are emerging from the early call report filers of first quarter 2020, retouch a bit on the interagency guidance on risk review systems that was finally released a couple of weeks ago, talk a little bit about a solution that we feel like we have relative particularly to the COVID-19 environment, speak a bit about a soon-to-be formed credit forum in LinkedIn, and of course closing in how you can participate in the IntelliCredit solution. Let's talk a minute about where we are from a credit perspective. We're clearly in the worst economic downturn since the Great Depression. Nothing has been this dramatic in any of our careers, of course. Going from arguably full employment just a couple of months ago to at least the latest in April of 14.5, probably getting worse. We have got to realize, irrespective of the turn in the economy where people are beginning to emerge and going back into some degree of normalcy, that COVID probably brings us a totally new credit cycle that requires a new game plan for credit risk management going forward. The good news is the financial industry clearly has much more capital, more liquidity, and more improved risk management systems than we had at the beginning of the last financial crisis of the Great Recession. I think an added silver lining, if you will, on this crisis is that no one could blame the financial industry for this, and therefore there should be no presumptions of punitive regulations to be forthcoming as a result of it. We certainly appreciate, even in today's webinar, you taking the time to join us today, because we know that most of you listening have been up to your necks in trying to book COVID-related loans and modifications and participate in the PPP program and so forth. So we do understand that and appreciate your taking this time today. One of the things that has been very interesting in this has been loan growth opportunities are already showing in early first quarter 2020 call report information that loan growth is clipping upwards and likely to show even stronger growth. Some of that is bringing down credit lines. Some of it is just, and as we look at deposits, which have significantly increased over the financial industry, some of that may be people pulling down credit lines or just simply not spending in terms of their traditional levels. But what we have to accept is that irrespective of any temporary regulatory relief, that financial institutions are not immune, will not be immune from general compliance, reputational, operational, or economic risk emanating from this crisis. Even before COVID came along and the black swan that it is, I had begun to realize the importance of what I call commodity valuations that impact credit quality. And what we mean by that is whatever industry we were lending into, it's the value that the market places on the products coming out of that industry that have a huge effect on underlying credit quality in our banks and credit unions. An example of that, it was 1 to 4 family housing that had such a collapse of valuation that led us to the Great Recession. But in that exact same period, there were states and regions that were more energy dependent or energy focused that had much less credit stress because at that particular point in time, that commodity was not as stressed. So I think that is a key part of understanding where we are today, because I think the COVID crisis is going to have disproportionate and disparate, rather, impacts on various so-called commodity valuations of the industries we are lending into. Specifically, what we are recommending that banks and credit unions do at this point is to particularly look at concentrations and correlations, and that goes well beyond just real estate, which is most people think in terms of. It's really all things relative to growth, profitability, and quality in your portfolio. I use the term correlations because there's kind of a subset of concentrations that I think is very important for risk managers to be sensitive to. It really wasn't just the tract loans and the construction loans that caused so many banks to fail in the last crisis. It was banks that were had a heavily correlated portfolio to all things housing. So I think that's one of the things we have to be looking at. Related quite closely to that, of course, is industries, and we're big advocates of using NAICS codes to begin to take deep dives in your portfolio to understand what types of industries, obviously service-related come to mind, everything but possibly grocery stores are clearly under stress at this point. Vintages, another lesson learned of the last crisis was that unfortunately loans made late in a credit cycle tend to be the most toxic. We clearly learned that through empirical evidence last time, and a lot of that is driven because that in the late stages of a very benign credit crisis, there's a lot of chasing growth, and sometimes standards are sacrificed as a result of that. So being able to aggregate, segregate your portfolios based on vintages, I think, is clearly important. Every credit professional on this call today probably understands this, that it's the real art of understanding, detecting emerging credit risk and mitigating it is not within the criticized classified categories. It's within risk grade migrations within past. We're huge advocates of that. And frankly, that is indeed the heart of what IntelliCredit is all about. Relative to some red flags we'd like to share with you today, excuse me, is to this last point, and that is we have a structural bias in our financial industry to recognize problems too late in the game if we don't watch it. And we use that kind of conundrum that has emerged in our world of saying all loans tend to be good loans until they're bad loans. But because one of the issues that again, we founded IntelliCredit about is to make sure that risk managers are sensitive to that, avoiding that conundrum. One of the things we're going to have to fully accept is that the old adage that has been thrown around for some years now that, well, we've had regulators in for a number of cycles, we haven't had a single downgrade. That's old news now. That's not going to apply given the potential extent of this current crisis. We've clearly had a decade of subsidized low rates from the Fed, and they're likely to go even lower, even though Chairman Powell has said this week that there's no intent to lower the rates any lower the remainder of the year. And frankly, that has a disproportionately problematic aspect to smaller financial institutions, as you know. Some immediate credit concerns we'd like to share with you. We've already alluded to certainly service industries to the degree you've got significant amount of service type, restaurants, hospitality, that type of thing that clearly have borne the brunt of this crisis as we're in. That certainly would indicate you needed to begin to quantify those. Conventional retail. Now, many of you think of, well, I'm not sitting here with exposure to big box shopping malls, and we understand clearly what e-commerce has done to that industry. But what I am here to remind you that many community financial institutions, in fact, I would argue as much as 90% of the retail strip centers, not the malls, but the retail strip centers that populate the suburban and rural areas. Many of those are financed at the community financial institutions. Some of the smaller banks and credit unions perhaps have, particularly in the Midwest and Mid-Atlantic, have looked to the leveraged financial transaction. It's a kind of a subset of the shared national credit. These are highly levered C&I loans that largely part of a syndication groups that people have taken slices of that were already beginning to show some stresses even before the COVID impacted credit problems. Some may be surprised at nonprofits. Here's an example of perhaps an unwitting result of the 2017 Tax Reform Act, which basically de-incented charitable giving by doubling the standard deduction. For example, in 2018, arguably a very robust economic year, nonprofits had $68 billion less in charitable gifts, and of course that's top-line revenue for nonprofits. And that is a credit issue because many smaller financial institutions have increased their exposure credit-wise to nonprofits over the last couple of years, particularly to overcome the concentrations in real estate. We all know about agriculture on an inflation-adjusted basis. Their profits are down and their debt is up as high as it was in the mid-'80s when we had the last agricultural crisis. And of course, that's being exacerbated by trade issues and tariffs and what have you. Consumer credit quality has been a bit stressed, showing the first signs of stress about a year ago. 80 to 85% of all the net charge-offs in the commercial banking space prior to this crisis has been coming from the consumer purpose portfolios. Some would say that doesn't apply as much to the smaller, particularly smaller commercial banks, because they kind of moved away from heavy dependence on consumer lending in the last decade or so. But I do think, particularly credit unions that may be listening, that certainly is a concern in terms of concern. And there's also beginning to be some data that indicates that wage workers, lower income wage workers are being disproportionately impacted by the COVID crisis, which certainly becomes a credit issue for banks holding debt to those. One of the things that we have had some real concern about, frankly, even before the COVID crisis was certain CRE segment valuations, particularly in office space, and ironically, that obviously is going to be impacted significantly going forward given the work at home, stay at home environment that so many people are involved in these days. But I had a trusted regulator tell me about a year ago that he saw some haunting similarity between particularly office space valuations in the market that conjured up memories of how wonderful family valuations were spiking just before the crisis of 2008. Also, we have to understand that there's some structural problem or disadvantages to smaller banks. Capital, the subjective sense that you often know these people that are become problem borrowers in your banks. But what we did learn empirically from the last crisis is that banks that are slow to the game of either dealing with problems that emerge always incur more losses. We'd like to take a bit of a time at this point to look at some data that comes from our sister division, Quick Analytics. And I think, again, we're looking now at some interesting information coming from the Q1 20 call report filings, of which we have about 90%. Quick Analytics in real time is able to understand what is to digest and ingest the data coming from call reports as filed. And as you can see here, and this is the broader CRE risk, the risk-based capital, it's basically the 300% guidance that has been in existence since 2005. As you can see, an uptick in exposure, at least in the 90% of the call reports filed. Some of This may be a little bit anomalous behavior in this because we've seen a downtick in the number of banks that, at least as of year-end 2019, that are in excess of 300, which may mean that the 10% of those that have not filed yet have even higher exposure of real estate beyond the 300% suggested guidance. What, however, this tells us for all of us is that we as a financial industry have apparently taken more exposure in CRE, and CRE, commercial real estate of all forms, has to be put under the microscope in terms of what that pretended risk is in our portfolios going forward. The subset of that, of course, is the 100% guidance on construction and development loans. These lines tend to follow demographic moves in the nation. The Southeast, for example, presumably still showing some indication that people are moving into that region. That obviously shows more and more construction and development. But one of the things that is interesting here is that just this morning we did have some very, very good news that the weekly mortgage applications had, on an annualized basis, were down only now 1.5% compared to last year, and certainly improved from last month's equivalent read of 35% down. So there is some indication that maybe the housing market is beginning to show some signs of being rebounding. Other concentrations we tend to look for is multifamily, showing some uptick again, being a real estate subset. One of the most interesting to me has been the uptick in the C&I loans in terms of its exposure to risk-based capital in the first quarter among the 90% filers. That could be a result of March activity in more business loans that were done, but it also could be, credit lines, large credit lines being drawn down. Remember, these are loans. This data reflects 10 billion and under sized banks. Ag, of course, is trending somewhat downward, but this also only represents ag exposure in the commercial banking space. Three metrics that I have always looked to kind of paint a picture of where either the industry is or an individual financial institution is relative to credit quality would be to look at what the non-performing loan inventory is, if you will. And you have but two things you can largely do in oversimplified terms. You can either charge it off or you can reserve for it. So the inventory of problems, which is the chart to the left, again, in the parlance of the industry the day today, the curve appears to be either flattening or rising in terms of some acknowledgement of NPLs. The blue line, the thicker blue line, by the way, is the national trend. Charge-offs have declined, but that's not unlike most smaller financial institutions, which tend to have a sawtooth aspect to charge-offs on a quarterly basis, being that most charge-offs tend to be incurred at year-end for most of the smaller institutions. But again, perhaps more importantly, the ALLL, the loan losses to loans, are clearly showing at commercial banks an uptick, a recognition that we're beginning to recognize the potential credit aspects of this crisis. So we're going to be looking a little bit later in the presentation at the COVID-19. We understand that the phase of just being consumed by booking the loans is now going to be replaced by, okay, how do we monitor and manage these loans? As I said before, we are now in, and I've talked to a number of bankers in the last 2 to 3 weeks who clearly said we don't begin to expect that things are going to get back to normal this quickly, and we understand there's going to be a residual credit drain to this COVID situation for some time to come. I think it's quite important now to avoid any trap of managing credit by trailing indicators. For example, what our credit metrics look like at year-end 2019 at this particular point is virtually meaningless. It's not the revolution of 10 years ago in credit risk management was, I think, We have to become much more probative, kind of focused on what might happen, what likely will happen, not what did happen. So it's so tempting in an environment like this to be overtaken by the presumption that this crisis is so existential, so impactful, so beyond our control. But I'm a strong believer that any circumstances such as this requires us to be, in the end, the captain of our own ship by understanding our position, quantifying it, and then most importantly, describing it, as I would say, before the regulators do it for you. And that's certainly the case here. That leads us to explain what are we talking about at IntelliCredit. And I would be the first to say that any solution, product, what have you, that doesn't relate to some type of solution is not of much meaning. So from our perspective, what IntelliCredit is both an integration of what the division means and also the products we are developing. So bear with me for a moment to just explain what is IntelliCredit as a division of the Quick Rate family. We start out with two aspects. One is public data, which is largely call report data, and our sister division, Quick Analytics, does an excellent job in wrangling and managing bank data and research tools. The other part of the banking world, and particularly as it relates to credit, is what we call non-public data. And frankly, that was the genesis of IntelliCredit, and that was the ability to understand what goes on within a bank's proprietary data that doesn't become part of the call report world. And I think that's quite important. And IntelliCredit largely has divided that process into two components, and that is the portfolio analyzer and the smart loan review. And we are very comfortable with that. And the other concept we have is the ability to drill down from macro aggregate information down to individual transactional loans and exceptions relative to those loans. Using this, in our team, we call this peel the onion in some cases, but taking it from a macro down to a transactional level. And then I think most revolutionary, because I don't know of it being done anywhere else, and that is we have taken loan review, which arguably for 40 years has been unchanged as a model, and make that far more robust and connected to the real-time, day-to-day analysis of the portfolio as a whole. Obviously, you can get public data, as I said, from call report or like Quick Analytics, but as you begin to have to peel the onion, as I think you certainly do need to do in this crisis such as we're in today, is you would need tools and approaches that would give you the ability to do that drilling down or peeling the onion. And then again, what we like to think is quite revolutionary for us is that we've attached that to the loan review process. So examples of that, red flags. Here's a perfect example coming from Quick Analytics, the credit risk matrix. This indicates that there may be some concern emerging in this particular bank that has heightened exposures in certain areas. But that may also, there are also red flags that can come out of IntelliCredit. I might add that the data that I just showed you from Quick Analytics, that's what basically the public sees in terms of investors, in terms of regulators, and in terms of peers. Some of that data may beg questions. Some of that data may certainly beg further explanation. That's where IntelliCredit comes in, I think, providing you that deeper dive into either explaining anomalies or maybe even countering what maybe a public perception may be in your bank. Again, these are things that we're going to have to dust off and be quite capable of doing, I think, in the next couple of years as a result of this crisis. So an example of a red flag coming out of IntelliCredit would be, as you can see, in this case, this is basically using illogical pricing, where secured non-owner-occupied commercial real estate indicates that the pricing is not very logical, commercial industrial loans between risk grade 3 and risk grade 4 are virtually the same. So there may be reasons to try to drill down further as to what's going on in those categories. Aggregate portfolio trends, again, we're in kind of the macro level of the portfolio, is what does that mean? One of our favorite approaches is to, as I alluded to before, is what is going on in the past credits. You don't need to wait until it goes over to non-pass loans. They're the ones that the public and the regulators and the investors see. A good credit risk manager understands that the real art of mitigating risk and reducing losses is where am I seeing emerging risk in these past categories. And this particular depiction shows that between September 30th of 2019 and 3/31/2020, there's been a migration of the bell curve to the right, which would imply that there is more heightened degradation of credit potentially. As you can see, even on the non-pass, which again, this is the public, it's actually shown an improvement in credit. So this is another example of how you show a far more robust circumstance within what's going on in your credit. The next level, of course, is loan level details. So what among these aggregate portfolio trends is really causing the anomalies or causing concern for us? And at that point, we can we pull reports and segregate areas. For example, in this case, relative to past due distribution for this particular loan officer, showing that 60 to 90 days past due of over $1 million, and then gives you the ability to drill down and determine what is the inventory of loans that make up that concern. And then the more revolutionary part that we talked about before is our ability to, if loan review is being used in this module, then you would have the ability to drill down to individual loan reports and even all the way to what might be considered very obscure exceptions on either a documentation, credit, or policy level. So that's really the concept of what IntelliCredit's about. It's also the means by which we like to think we've created solutions that would be very pertinent in this crisis that we're in, and particularly relative to loan review that we just mentioned. The regulators pushed this out back in the fall relative to some concerns they had, making sure the financial industry, and this is the interagency that includes the 3 primary commercial bank regulators as well as the NCUA for credit unions. The final guidance was issued May 8th of this year, and we are very, very proud to say that at IntelliCredit we feel very comfortable that every aspect of the new guidance that was issued is covered and integrated into our deliverables. So at this point, I'd like to hand this over to Larry Poole, who is Director of IntelliCredit, to talk a little more specific about COVID-19, because that's certainly on most everyone's mind in terms of what the environment is there and how we move beyond just the booking of those loans to the managing and monitoring of those loans. Larry?
Thank you, David. Thanks for everyone for your time today and joining. I wanted to just take a couple minutes. We started really in mid-March, began receiving questions from chief credit officers and the risk function of the bank, essentially saying we're already getting feedback from borrowers that they're under stress. We're hearing from the regulators that, yes, we need to be proactive in monitoring these loans, but there was some real fear there. If we start giving modifications to COVID-affected borrowers, these look a lot like TDRs to us. So we've been answering those questions daily, even through May, and just wanted to really draw your attention to a couple things. One, on April the 28th, the regulators, and that includes, as David said, the 3 major banking regulators as well as the NCUA, they did a webinar, which I've referenced here at the bottom, an Ask the Regulators webinar. It's available on their site for review, and if you haven't checked it out, I'd highly encourage you to do so. It's a 1-hour webinar, and it addresses a lot of these technical questions. And I just want to take a moment to talk through what I think are some of the biggest technical questions related to COVID-19 modifications. So today, you primarily have 2 sets of documentations that govern the question, if I modify a loan, what criteria must that loan meet to not be identified or flagged as a TDR. So the first set of documentation was passed by Congress. Section 4013 of the CARES Act was passed at the end of March, and it essentially said if a loan meets these three criteria, you can modify that loan and not flag it as a TDR. So number one was it has to be COVID-19 related. The regulators have been very explicit that COVID-19 doesn't have to be the primary cause, it just needs to be a contributing cause. So for instance, if you had a loan to the oil and gas industry, a borrower in the oil and gas industry, perhaps they were already experiencing some difficulties prior to COVID. If COVID has exacerbated their problems, that's enough to be able to modify that loan and say, hey, this was a COVID modification that we don't need to recognize as a TDR. Number two, the CARES Act said that the loan had to be current as of 12/31/19. That was pretty explanatory. And number three, they said that the modification had to be executed during the applicable period. And the CARES Act defined the applicable period as the loan had to be modified between March 1st, 2020, and the earlier of 60 days after the termination of the national emergency, which it hasn't been terminated, or fiscal year end 2020. So what in my understanding just says that modification has be between March 1st and year end 2020. On April the 7th, the interagency put out a revised guidance that had similar characteristics with some slight differences. Number one, the interagency statement from April 9th said that the loan had to be COVID related. They said number two, that it had to be current at the time of modification or program implementation. And one of the things that I've realized from talking with regulators and reading different trade group work papers and reading from the regulators have given flexibilities to banks and credit unions to determine what current at modification program implementation means. So I've heard some accounting firms say a loan has to be current at the time of modification. I've heard some say that it has to be current at a point in time. The regulators have given flexibility to banks and credit unions for you to determine what is that point in time. So you could even pull loans, let's say at the end of February, that they hadn't been affected by COVID, but in 6 months a loan potentially needs to be modified. If this loan was current before it was affected by COVID, my understanding is that that could be a COVID modification that you do not have to flag as a TDR. Now, I would caution and say I'm not an accountant or a regulator, but that is my understanding. So work through your accountants and regulators, but I just want you to know there is some flexibility there. And then the third thing within the interagency statement, they said that a COVID modification had to be short term, and the guidance explicitly says 6 months. As a matter of fact, on that Ask the Regulators webinar, they gave the example, if you modify a loan today for, let's say, 6 months, at the end of that 6-month period, it needs another month or 2-month modification. Can we still not, are we still able to not flag it as a TDR? And the answer to that question is no. Basically, anytime you get past that 6-month guidelines, then you need to revert back to TDR accounting. So just wanted to point this out. These were kind of some of the technical implications of modifications related to COVID. But now I want to talk more about practical. How does that result? How should we begin managing this as the credit function within our financial institution? So number one, while interagency guidance has provided some accounting relief, regulators have been very, very explicit that doesn't absolve us of appropriately adjudicating credit risk within our loan. So we know as credit professionals that even though we're able to give borrowers short-term relief right now, those COVID modified loans are going to remain a hotbed for future potential credit issues and credit losses. And this goes to kind of my next point. My recommendation right now is financial institutions have got to be vigilant and not just managing their COVID effective loans from a quantitative standpoint, but also qualitatively. So quantitative just simply said, here's my list of COVID loans, here's my counts and my balances. But qualitatively, how are you managing emerging risk within that portfolio subset over the next 30 days, 60 days, 90 days, 6 months? And this gets back to David's point about being the captain of our own fate. understanding your position related to COVID loans today, quantify it, and then be able to write your narrative before your regulator does that for you. Now, we want to show you real quickly, spend about 5 to 10 minutes on what we've developed while banks and credit unions have been working hard on all these modifications. We've been putting together a tool which we think helps solve this COVID management problem. And if you're able to view this portion of the webinar, if you're calling in, please check this out, because we're going to be showing this. But also stick with us, because we're going to offer for your bank or your financial institution right here at the end. So let me show my screen. What you're looking at right here on my screen is what we refer to as our IntelliCredit portal. Now, the IntelliCredit portal is essentially made up of two parts. It's made up of our portfolio analyzer tool and what we call smart loan review. And the part that I want to focus on today is what we have coined the COVID-19 portfolio tracker. But before I talk about the portfolio tracker, just to give you some context, I know some of you may have said it on previous webinars and have seen this, some of you haven't. The way that our tool works, essentially your financial institution would give us a core system download to upload within our application. And we're completely agnostic to core system providers. We've worked with Jack Henry, Metavante, Fiserv, BankPack, a number of others. But you would give us the data dump at each month end or at each quarter end. We take on the effort of doing the heavy ingest into our software, so it's easy for you. You can see in this demo financial institution, which we've called Pawnee Community Financial, we have uploaded 5 core system files. To give you an idea of kind of how this is organized, on the left side of the screen is just some standard reports that David spoke about that help identify our emerging credit risk within your portfolio, not necessarily trailing indicators, but pro forma indicators. We've got the portfolio tracker here in the middle of the page. If I just scroll down the landing page, we have taken the data and organized it so that we can put you in the analytics seat and not the data aggregation seat. One of the things that David talked about is being able to drill down from macro level to the loan level. Every chart, graph, and table that you see is interactive and can be manipulated. So for instance, this bottom chart shows my distribution of portfolio balances by risk grade. Let's say that you just wanted to see your criticized and classified loan. I can change my criticized and classified loans just by clicking on the legend at the bottom. Over here on the far right, as of 3/31/20, my financial institution is showing $7 million in criticized and classified loans. If you wanted to know what those were, by simply a double click or a single click, you can see the 11 loans, the $7 million in balances that make up that data set or that subset as of 3/31/2020. So every cell, you can see the little hand as I move around here. Every cell can be drilled down into to see to just see the subset of loans that make up that data. For instance, another thing that David talked about, let's say if you wanted to look at your distribution of loans by loan officer. Here's our distributions of loans by loan officer. If I wanted to see what was in Samantha Powell's portfolio, I could drill down. And we take this all the way to the smart loan review level. So on this far right column, you can see that we have a loan right here to Ania and Associates, which was reviewed on January the 6th. You can click this hyperlink and you can easily get to the loan review report for IntelliCredit. So I'm not going to go in too much of the portfolio or the IntelliCredit portal as a whole. I just want you to know that it's kind of made up of 2 parts, our portfolio analyzer and our smart loan review, and we're happy to demo that for you one-on-one. But what I want to spend some time on is COVID tracking. So one of the things that we're able to do within our portfolio analyzer, once the flat file or the core system file is uploaded, we can actually assign loan tags to the portfolio. So for this demo bank, you see 789 loans, 320 million in balances. If I wanted to see my COVID-19 subset, I could click on that subset, and out of my 790 loans, roughly 140 million, 68 in balances are COVID related. If I wanted to, so this is the quantitative piece that we're talking about. The qualitative piece of that, this COVID loan tracker, what we have put together is based on the interagency guidance and the CARES Act. We've essentially built an interactive dashboard where each loan officer or credit officer at your financial institution could have a login to help actually manage the risk within these loans. So looking at this first example, Aenean Associates, you can see the note number, balance, and exposure, the risk grade, the three indicators from the guidance. Was it past due at 12/31/19? Was the reason for modification COVID related? And what was the date of modification? If I scroll over to the right, we just have a comments log. So as new facts and circumstances become available, you can add them here to the comments log. And then you also have the ability to upload any files that are related to the comments log. So let's say that in 3 months' time, this borrower has not recovered as they anticipated and you need to make a downgrade. You would just simply click the edit button on the left. We could add another comment here. So I'm going to just give an example. In 3 months, let's say we loan downgraded to risk grade 5. Once I add my comment, save my data, and close, you'll see that the comment log right here is updated. Looking at this example, you can see that on March 15th, 2020, that the borrower contacted the bank and requested a payment deferral. Maybe you wanted to upload that payment deferral email, so you would have the ability to upload any files that relate to that specific loan here. And here's the email from the owner, Tom Harden, basically saying to the loan officer, hey, can you work with me? I need some sort of modification. If you needed to add a new loan to this, so let's say that in the next month a loan needs to be added to this COVID tracker, it would be as simple as searching by borrower name or note number. So I'm going to search and say London Golden. We want to add her to our COVID list. You just select her loan, and then you'd go through the process of how many days past due. Was it at 12/31/19? What was the date of the COVID modification? What is the type of COVID modification? So maybe it's 90 days, interest only. We've given you the ability to track the NAICS industry code, the 2-digit code. I'm going to leave that blank for now. You could log your reason for COVID modification and then any comments that you wanted to make related to this loan. When I save, you also have the ability, again, as we said, if you need to upload files to kind of help track what's going on with this loan, you have the ability to do so here. Once I save and close out, you'll see that the loan has now been added to my tracking portal. Also, my loan counts have been updated. It was 140, now it's 141. And now when I also go back to the portfolio analyzer and I view this subset, my COVID-19 subset, it's also been updated. So it's updated within the analyzer as well. Again, one of the biggest things that we think is we've worked with 3 or 4 financial institutions already on this, and they're typically tracking their list of COVID loans, but they don't have a good way to manage it. Now, keep in mind, we're talking about potentially dozens or hundreds of loans that have been modified, and that's a very tough task to manage when you've got 5, 10, 15, 20 loan officers who are represented within that portfolio. So this is essentially a secure web-based portal that everyone at your bank can get into and update their COVID-19 loans as new information becomes available. So I'm going to turn it back over to David right now, and he's going to talk a little bit about just kind of next steps and offers that we have for the credit unions and banks represented on the call today.
Yes, Larry. One of the things that I think you've certainly detected today is that this has really been as much about trying to share with you our perspectives on credit in a generic sense, not just to push a product. Hope you respect that. And in extension of that, what we are planning to do is also create a credit forum that will be open to all interested credit professionals of financial institutions that would be focused on the sharing of topical trends, particularly as we hopefully get through into some recovery, but understanding there will be a trailing component of that in terms of credit risk assessment and experiences. Also having a forum is an exchange by definition, and that would be having all credit professionals share their experiences, and hopefully, we can add a little bit here and there. Watch for a coming email announcement of those further details. And Larry, I'll throw it back to you on just exactly what we can do to close out today's webinar.
Yeah, so thanks, David. So one of the things that we wanted to do is just provide, while our banks and credit unions have been working hard on modifications and PPP loans and admittedly overwhelmed, we thought, what is this going to look like for bank management 30, 60, 90 days from now? One of the things that I was reading a trade association article last week was probably a 1,000-word article, and it was going through all those technicalities of COVID-19 modifications. But in the very last paragraph was this quote that you see at the top, which was almost a throwaway quote, and it said, while financial institutions don't need to report COVID-19 modified loans as TDRs, they must maintain records of these loans. It is likely that starting in second quarter 2020 reporting, there will be some requirements to report on these modified loans. Please plan accordingly. We realize that time is of the essence. We are there where soon regulators are going to be coming in and say, let me see your COVID-19 portfolio and how are you specifically managing this portfolio. You're going to have to track it for regulatory purposes, but you're also going to have to track it to kind of minimize those risks and minimize those losses. So the offer that we would like to extend to anyone on the call today, if you will give us a singular core system flat file or your loan tape or an Excel workbook, however you're tracking loan, if you would be willing to give that to us, we will ingest it into our portfolio analyzer software. We'll do the heavy lifting. And then we'll like to spend maybe 45 minutes in just a one-on-one demo with your bank or credit union to show you what your data looks like. No cost obligation. And from there, you can decide, hey, we think that this portal and this loan portfolio, COVID portfolio tracker really fits well with what we want to do. And we could have that talk from there. But we would like the opportunity to see your data, ingest your data, and then do a demo with you on your institution-specific data free of charge.
Thanks, Larry, and particularly thank you for your valuable time today. We do know that you've got so much going on relative to the COVID-affected lending activities, but now we know we're going to have to start monitoring and managing. If you want to participate in this, please contact us at info@IntelliCredit.com. We would love to spend some time with you one-on-one, and again, we want to thank you so much for your participation today.